Owning a home is considered as everyone's dream. Yet, for many, the path to homeownership is paved with decades of mortgage payments, thousands of dollars in interest, and the nagging feeling that the home isn't truly yours until that final payment is made. But what if there were a way to navigate this path more swiftly and efficiently, without increasing your monthly financial burden? Welcome to today's topic, where we'll explore a strategic approach to mortgage repayment that might just change the way you view your home loan. We'll dive into the concept of increasing the frequency of your mortgage payments, turning a standard 30-year agreement into a faster route to complete homeownership. By understanding how interest works and leveraging more frequent payments, you could save thousands of dollars and shave years off your mortgage. The information in this video should not be construed as financial, legal, or investment advice, and I assume no responsibility for any decisions made or actions taken based on the content of this video. Please remember, financial decisions should be made with careful consideration, professional guidance, and a thorough understanding of the potential risks and benefits involved. Whether you're a first-time homeowner, considering purchasing property, or simply seeking ways to manage your existing mortgage more effectively, this video will offer insights and tools that can help you navigate the often complex world of home finance. A standard 30-year mortgage is a common type of home loan where the principal amount, combined with interest, is paid back over a period of 30 years. The interest rate may vary, but for the sake of this explanation, let's assume a variable interest rate. The interest on a mortgage is typically compounded monthly, which means that each month, you pay interest on the outstanding balance of the loan. As you make monthly payments, part of that payment goes toward the original amount borrowed, and part goes towards interest. Over the course of 30 years, those interest payments can add up to a substantial amount. In a variable interest rate mortgage, the interest rate is not fixed for the life of the loan. Instead, it can change at predetermined intervals, such as annually. The rate is typically linked to a specific financial index, plus a fixed margin. Initially, variable interest rate mortgages may start with a lower interest rate than a fixed rate mortgage, but that rate is not guaranteed to stay the same. Depending on economic conditions, it can rise or fall. This means that your monthly payment can also change, reflecting the adjustment in interest. If you buy a home for $250,000 with a $50,000 down payment, your mortgage would be $200,000. Let's consider a $200,000 with a 30-year variable interest rate mortgage with an initial interest rate of 6%. That can adjust annually. On a $200,000 loan at 6%, if interest compounds monthly, you would pay around $1,000 as interest in the first month alone. The goal of reducing both the interest payments and the overall term of a mortgage without increasing monthly contributions is a financial strategy aimed at paying off a home loan more efficiently. This approach can lead to significant savings over the life of the loan. Here I am going to explain in simple words how it can be achieved. Step 1. Reducing interest payments. Interest payments can make up a substantial portion of the total cost of a mortgage. By reducing the amount of interest paid, a homeowner can save thousands of dollars. How it's achieved. Instead of making a monthly payment, you can break it down into fortnightly or weekly payments. Though the total monthly contribution stays the same, this strategy can lead to one extra full payment per year, reducing the principal more quickly and thereby decreasing the overall interest paid. Increasing payment frequency. With a standard mortgage, you typically make one payment every month. Over the course of a year, you'll make 12 payments. Fortnightly payments divide your monthly payment in half and require you to pay that amount every 2 weeks. Since there are 52 weeks in a year, this results in 26 fortnightly payments, which equates to 13 full monthly payments over the course of a year. Weekly payments divide your monthly payment by 4 and require you to pay that amount every week. Over the course of a year, you'll make 52 weekly payments. The weekly payment plan would further reduce the compounding effect and could result in even more interest savings. However, implementing a weekly payment plan might not always be possible with every lender or may require careful scheduling on your part. The more frequently you make payments, the quicker your principal decreases, which leads to less interest accumulating due to the compounding effect. In a standard mortgage, interest compounds monthly, so by making more frequent payments, you're reducing the amount on which interest is calculated more quickly. Step 2. Reducing the overall term of the mortgage. The term of the mortgage is the number of years it will take to pay off the loan completely. A standard mortgage might have a term of 30 years, but reducing this can lead to further interest savings. How it's achieved. Extra payments towards principal. By making extra repayments to your mortgage, you're paying down the principal faster, which means the loan will be paid off in fewer years. If the loan agreement allows, making additional payments directly to the principal, outside of the regular payment schedule, can also reduce interest, as interest is typically calculated based on the remaining principal balance. While increasing the frequency of mortgage payments can lead to interest savings and a shorter loan term, there are potential drawbacks and restrictions that need to be considered. Some mortgage agreements include prepayment penalties, where the lender charges a fee if you pay off a portion or all of the loan earlier than the scheduled term. This can negate some or all of the financial benefits of making more frequent payments. Not all lenders may allow you to switch to a fortnightly or weekly payment plan. Some might require you to adhere to the original payment schedule, limiting your ability to reduce interest costs through more frequent payments. The total monthly contribution might remain the same. More frequent payments could impact your cash flow, particularly if you are paid monthly. Ensuring you have sufficient funds available for weekly or fortnightly payments requires careful budgeting and financial management. It's advisable to consult with a financial advisor or directly with your lender to understand any penalties, restrictions, or other potential issues specific to your mortgage agreement. Understanding these factors will help ensure that the strategy aligns with your financial goals and doesn't result in unexpected costs or complications. Many homeowners find themselves locked into long-term mortgage agreements without realizing the possibilities available to them. Understanding how mortgages work, especially the intricacies of interest calculations, can lead to substantial savings and a quicker path to full ownership of your home. One such strategy is increasing the frequency of your mortgage payments. Speak with a mortgage specialist or financial advisor who can analyze your specific situation and help you determine if this strategy is suitable for you. Discuss with your lender the possibility of switching to a fortnightly or weekly payment plan, and clarify how additional payments will be applied. If this video has sparked your interest in potentially saving on your mortgage, take the first step by reviewing your mortgage agreement and consulting with a financial professional. Please like, share, and comment below with your thoughts, and subscribe for more financial insights.